Hey everybody, Jonathan Rose, owner, Masters in Trading. And today we're going to be talking about how to manage a shitty trade. So let's get into it. So in front of you, Sedge. Now Sedge is a trade that I shared with my members about September 15th. So right about here. And as you can see, since we've gotten in, it's gone against us. The market's strong, not surprising. Positions that express short bias on the overall market are going to have a very difficult time when the market's rallying. But nevertheless, I've gotten in this trade just like my members. I'll show you my exact trades. So here's Sedge. The reason we got in Sedge is because a company, GNRC, is getting into the US solar industry. I figured it would have a big hit on Sedge. I still think it will. It just hasn't just yet. But let me go over the trades that I've done and how we can now manage these trades. So going out to December, you can see I'm personally in the 65 puts and the 70 puts. And down here are my exact trades. The 65 puts, I bought a 10 lot for $2.50. Right now they're trading for about $1, so I'm down 62%. The 70 puts, $1.50 bid at $1.75. I bought for $2.75. Terrible trade. Right now it's at $1.60. So what do? We're always talking about our good trades. What about those trades that go against us? Now, the reason that I got in Sedge hasn't changed. The stock's gone against me. When I get into a trade, I want to figure out how much am I comfortable risking. So right now for Sedge, my original trade, I risked $2,500. The next portion of the trade, I risked another $1,300. So right there I have $4,800. So for me, I'm comfortable risking $6,000 or $7,000 on this trade. So the next thing I would do is I could add, but if I did add, let me go back to the chart. If I did add today, the third tranche that I would do, if I would, buy some options here, as soon as it goes down, I would cover. I would do a really, really quick trade. And I would do that trade because I'm looking to finance this holding. I'm looking to survive. Right away, I'm down money. I'm down about 50% of my overall position. So the third tranche, I would just do as a scalp. I would just try to take money out of the market to try to stay in the trade longer because I want to stay in the trade until expiration. Another thing that we could do is if the reason we like the trade is because GNRC is getting into US solar, we could buy GNRC. And this was a trade that I also shared, but unfortunately, the darn thing's gone up so quickly that I personally have not been able to get into the trade. I don't want to chase. I don't like getting into a trade once the train leaves the station because I believe that everybody who gets in late is just doing a favor for those who want to get out of their early position. Here's what I'm going to do to hedge this thing. And I'm going to do it live because everyone's so skeptical about this industry, rightfully so. You guys should be demanding that if you're learning from somebody, they're trading live. So what I've done is I looked for correlations with Sedge. And that takes me to ENPH. ENPH is another US solar company. You can see highly correlated to Sedge. ENPH is going to be the purple. Sedge is going to be the yellow. If we look at their historical behavior, going back to 2017, ENPH was pretty much like a penny stock. It wasn't really get involved in the game, started to capture market share, and since the beginning of 2019, they've been extremely, extremely correlated. So if I go back to the daily chart, you can now see just how correlated these two instruments are. So Sedge is going against me. I need to protect. I need to think about position management. So what I'd like to do is I'm going to buy ENPH calls. I'm going to buy ENPH calls, and I'm going to use those to hedge my sedge puts. So now let's go look at ENPH. Let's look at the options. So in doing some research, I learned some things about Enphase, ENPH. Specifically, they release earnings November 5th. So their earnings are going to be released in the November expiration cycle. So I want to be in November options. Why do I want to be in November options? To hedge against my sedge, that rhymes, December options? Because I don't want to pay for ENPH going out to December. I only want the earnings. What I also know is ENPH, over their last 10 earnings releases, has had a bullish move 9 times out of the last 10. And the move's been pretty freaking significant. Last earnings, ENPH was up 33%. Time before, 31%. The time before, 13%. The time before, 12%. So ENPH can really move after earnings. And luckily for this idea, it usually moves up. So what I'm going to do is first I'm going to think, what's a 20% move? $25, a 20% move takes us up to 30. That's a pretty good move. So I don't want to buy 30s because then I need it to move over 20% and then significantly higher. So for me, I like these 27 halves. Now, normally I would be a $1.70 bid here or a $1.75 bid, but because everybody's so skeptical, I'm going to pull up and I'm going to buy a 10 lot right at $1.80. And I'm going to risk $1,800 to hedge my position in sedge. So now that's going to give me a little bit more time with my sedge. I'm not going to have to do another tranche right away. If sedge goes higher, I will do that extra tranche. But now I feel a little bit more comfortable because I have ENPH, which is helping hedge my sedge. If sedge goes up 20%, I have no doubt that ENPH will also follow suit and be up 15%, 20%, maybe 25%. And hopefully the 6 or 7 grand I lose on sedge is made back on ENPH. That's exactly how I'm managing the trade. If you have any questions at all, any thoughts, comments, please, down below in the video, leave a comment, give it a thumbs up. I'll reply to each one of your comments. And thank you so much for spending time with me. I appreciate it, guys. Thank you. Jonathan Rose, owner, Masters in Trading.